when you're thinking, you're doing your asset allocation, what is going to protect your real after-tax returns so you create that optimal mix. Gold is a very excellent diversifier of the portfolio. So if you were to look at, just from the strategic asset allocation mix perspective, you would probably have something like, as the optimal mix, something like 15% of your portfolio in gold, because of the fact that if you didn't even have a tactical, because it is the one asset that does very well when the typical parts of your portfolio go down, because the typical parts of your portfolio are also so credit dependent. So anyway, I think all of this means that there should be some piece in that of gold. If I'm making tactical bets, I don't like debt assets per se. And I would say I don't like debt assets per se, not just government debt assets, but also if you're looking, let's say, at credit or private credit, and you look at where the credit spreads are. Credit spreads are very, very low. And so for those various reasons, my tilts would be away from those things.
And toward gold. But
again, yes, so more than would be a normal asset allocation mix. But I think you have to also say, start with what is a real dollar, if you're a dollar investor, a real return asset that you're going to hold as part of that portfolio. The most of the system is dependent on credit. Equities and everything is dependent on credit. You change credit and then all sorts of things happen. And so it's an effective diversifier, as well as probably the timing seems good.